Hello and welcome to the 18th edition of our Tax Update series. I'm Andy Rainford, your host, Chartered Tax Advisor and content creator. This week we have news of the government's business rate support measure for English pubs, a false threat of penalties from HMRC, and a case looking at whether a tax refund issued after death should be included in an estate as a taxable asset. So, business rates. And it will have been hard to miss the outcry from pubs and other hospitality businesses over the last few months. The concern is very real, as the government's revaluation exercise for business rates has threatened to see bills increasing sharply for 2026 to 27. Many businesses have reported rates doubling, or in some cases almost tripling. The government has now announced that a 15% discount will apply to 2026 to 27. Additionally, rates increases will be capped at inflation for a further 2 years. The support package has been criticised for not doing enough, and for excluding other hospitality businesses. One landlord on social media likened it to him announcing that the pint would be increasing from £5 to £10, and then announcing his customers could have a £1 discount for a year. I don't think we have heard the last of the backlash on this. You can view the announcement in full at the link shown here. Making tax digital for income tax is just 2 months away, and those that are likely to be affected this year will be receiving a second reminder letter. It's important that this is not ignored. As a reminder, MTD will be in point if a sole trader and/or landlord has relevant income exceeding £50,000 on their 2024 and 25 tax return. It's important to note that compliance is not optional, even if income has fallen below £50,000. Once the threshold is exceeded, there needs to be 3 consecutive years with income below the threshold, which is decreasing to £20,000 by 2028, in order to leave MTD. The only exception is where all qualifying income has stopped, so there would be nothing to report. Relief for job expenses and charitable giving tends to stay in a coding notice once they are claimed, as it is assumed that they will be more or less the same year on year. However, this is changing in some circumstances. The adjustments will be removed if the circumstances shown below are pertinent, for example, where the individual is not currently working. With the tax return filing deadline upon us, HMRC has been sending reminders by text message, all well and good, but one of the recent messages is misleading. It threatens a penalty if the tax is not paid by the 31st of January. This is incorrect, as a penalty won't apply until the payment is 30 days late. Of course, interest will always be charged on late payments, but this is not a penalty. It's commercial restitution for the money not being in HMRC's bank account at the proper time. In this case, the tribunal considered whether a right to an income tax repayment counted as part of a deceased person's estate for inheritance tax purposes. Mrs. Thomas died in December 2020. Her son, acting under a power of attorney, handled her tax and inheritance tax affairs. In the inheritance tax return, an estimated income tax repayment was included as an asset of the estate. Later, a self-assessment confirmed that a repayment was due and HMRC paid it to the estate. The son then tried to remove this amount from the inheritance tax calculation, arguing that at the date of death there was no enforceable right to a tax repayment and therefore no property to tax. HMRC disagreed, and the dispute went to the tribunal. Under the Inheritance Tax Act 1984, inheritance tax is charged on all property in the estate immediately before death, and that term is very broad. It includes choses in action, in other words, enforceable rights, even if they have not yet been claimed. The tribunal decided that Mrs. Thomas's death crystallised her income and tax position for the tax year. On the facts, there was only one possible computational outcome, an overpayment of tax, and therefore a right to a repayment. That right was more than a mere hope. It was a genuine piece of property arising by reason of death, and so was brought into the estate under Section 171. Because this right was assignable and the amount was effectively certain, its open market value was treated as equal to its face value. The appeal was dismissed. The key lesson is that where the amount is effectively determinate at death, a right to an income tax repayment can form part of the estate for inheritance tax purposes, even before any return or formal assessment has been made. And that's it for this week. Don't forget to file your tax return this weekend if you haven't already done so, because you will definitely get a penalty for being late with that. From me, it's bye for now.
Thanks, Andy. It's always a busy time of year for my accountant friends, and I expect a fair few bottles of fizz will be popped over the weekend. Don't forget to check out our web shop to view our full range of tax solutions to help your practice. Visit the link shown here to pay us a visit.